NAS 100 XLE atomic alpha regime activated. Okay, here's the bottom line, right up front. Korea's staggering minus 14% crash just gave us a crystal clear 12-hour warning. It exposed a massive capital rotation into physical assets, signaling a major pivot into energy and defense, and out of tech for the US session.
All right, let's break it down. The whole thing kicked off right at the SEOUL close. This wasn't just some sell-off, it was a systemic deleveraging, a flash crash that absolutely blindsided everyone. And the scale of this? I mean, look at that number, a jaw-dropping negative 14% on the KOSDAQ. Let's be clear, this wasn't some minor dip. This was forced liquidation. This was the raw signal of pure systemic panic from the retail side. But here's where it gets really interesting. This is the core paradox of the whole event. You see the index absolutely hemorrhaging value, right? But at the exact same time, foreign institutions were net buyers. They were pumping in over 1.1 trillion won. So while the index was screaming sell, the smart money, the institutional flow, was whispering buy. So that brings us to the single most important question we need to answer today. In the middle of a total market meltdown, where did the smart money actually go? What on earth did they see that everyone else was missing?
And the answer is, the signal was never in the main index. You wouldn't find it there. It was hidden deep inside the supply chain. See, the institutional players, they completely ignored the market noise. Instead, they went in with surgical precision and started acquiring key hardware companies, the actual nodes that build the physical world.
Okay, so we've seen the effect in the market. Now we have to trace it back to the cause. What was the geopolitical trigger that set off this massive, sudden repricing of risk? It all boils down to what we call a kinetic friction event, a flashpoint ignited in the Middle East, suddenly creating the very real threat of a blockade in the Strait of Hormuz. What happens next? WTI crude instantly spikes, and that spike forced a fundamental global repricing of all physical supply chain risk in a single moment. And this right here shows you the direct link, plain as day. You've got kinetic friction, military friction in one part of the world, and it creates a very real physical blockade for economic flow everywhere else. The whole seamless engine of global trade just grinds to a halt. So here's exactly how that works, the actual mechanism. Think about all those power-hungry AI data centers. They run on electricity, right? Well, when the price of crude oil explodes, the cost of that electricity goes through the roof. For these tech giants, that means severe margin compression. It's basically a direct tax on the entire digital economy. And all of this brings us to the absolute core thesis of this briefing, the activation of a brand new market regime. We call it atomic alpha. So what is atomic alpha? It's that critical moment of value redefinition. It's when the huge valuation premium placed on intangible things, like computation, suddenly collapses and is forced to submit to the hard, undeniable reality of physical, atomic friction. And here you can see the two competing value systems side by side. On one hand, you have digital efficiency. Think high bandwidth memory chips. On the other, you have physical resilience, the actual gas turbine that generates the power to run those chips. In this event, capital didn't just walk, it fled from the digital and ran straight to the physical. You have to remember, the entire digital economy, all of it, is built on a physical foundation of energy and logistics. It's the floor beneath everything. And when that physical floor is threatened, the digital premium, that extra value, the delta, it comes crashing back down to reality. What we saw here just proves a timeless rule of the market, one you should never forget. When the physical foundation of energy and hardware starts to shake, the digital superstructure built on top of it collapses. Okay, so now let's do what we do best. We're going to translate this signal from the Asian close directly to the US Open. This is the 12-hour warning we were talking about. Look, what happened in Seoul wasn't just some isolated event. It was a high-fidelity leading indicator. The blueprint was clear. Capital fled from digital to physical hardware in Korea. So you had to expect a highly correlated rotation was coming for the New York Open. It was practically inevitable. So the mandate is clear. Do not trade the headline noise. You trade the supply chain. The path of capital migration couldn't be more obvious. We're looking at inflows into the energy sector, XLE, and the defense sector, ITA. And you're expecting outflows from that high multiplier tech, like the QQQ. When you put it all together, the conclusion is just unavoidable. That big move in the U.S. energy sector, it shouldn't have been a surprise to anyone paying attention. The signal was broadcast with perfect clarity, a full 12 hours earlier, by the smart money making its move in Asia.
So what's the big strategic takeaway here? What's the new mandate for your portfolio? Because this event signals a truly fundamental shift. The core paradigm shift has arrived. We are witnessing the market's entire valuation axis rotate. It's shifting away from a singular focus on efficiency, digital efficiency, and moving toward a non-negotiable demand for resilience, physical resilience. From now on, capital is going to reward companies that have real physical moats that can actually withstand these kinds of supply chain shocks.
And all of this really just boils down to one critical question, a question you absolutely have to ask yourself right now. Look at your own portfolio and ask, is it built on a solid physical floor?
If you want the Asia close before New York opens, you know what to do. Subscribe. Be here